As much as markets love to climb the wall of worry, they also love to climb the wall of optimism. It's why it pays to be a bull, and more so when the Fed's Chair Jerome Powell is dovish, the market tends to rally. But after 24 hours to digest the FOMC conference, we have to start asking the serious questions. And the biggest one, why did the Fed abandon the 2% inflation target? Today, we talk about why and bull markets. Every bull market requires three things: bullish sentiment, liquidity, and IPOs. Today, Reddit had its IPO at $34 a share, and it kicks off what looks like a fairly strong summer of IPOs, with possible stocks like Stripe, Skims, and Shein looking to make their debut this year. So as the S&P 500 trades at all-time highs, we're also going to be talking about sentiment, how big money is positioned, earnings, and how this chart will dictate the rest of 2024. We have a lot to talk about, so let's roll the tape. Welcome everybody to the daily recap show where we talk about stocks in the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. You know how it works. The more comments you leave, the more likes you leave, the bigger this community gets. Let's get into it. Now, carrying on from yesterday's trade, a very green day in the S&P 500, especially early morning, but a lot of these mega caps didn't participate. Look at Berkshire, right? Tesla, Amazon, Google, Apple. That being said, the S&P 500 still up on the day, led mostly here by software, semiconductors. Any news, these guys get to rally, and they're just going to absolutely rally, as well as Microsoft. But it was green in a lot of sectors. Industrials were really green. This section here in real estate on the new housing data, as well as energy. And then this section right here in financials, asset management and capital markets. I have Schwab in my undervalued portfolio, and it's the worst performing stock in that portfolio. To see it get a bit of love today is really, really good. Now, when we have a pretty green day across the board, we're going to see some weakness here in consumer defensives, a mixed day in healthcare, as well as utilities. But all in all, a pretty green day in the SPY, although we did par a lot of the day's losses towards the end of the day. And we could see this right here in no better than semiconductors. Very green, up 4%, nearly 4% for the day. And then, absolutely came down. And that was the theme in a lot of the sectors. We saw really early gains and then end of the day losses, but still positive for the day. The SPY finished up 0.29%, and anytime you get a gain in the market, you take it, run with it. The best performing sectors was semiconductors and home builders. There was some news on existing home sales that came out really, really bullish, and that lifted up regional banks as well as real estate for the most part. The worst performing sector was GDX, as well as utilities and comm services. But that being said, you look at comms and actually just up on the day, mostly led by the flows in Google. They were down today, and then staples pretty much flat for the day. But all in all, a very bullish day across the board. Most sectors actually beat the S&P 500, beat the benchmark, and that we've seen this for the last couple of days. Sure, there's been weakness, but what we've seen is that these sectors are actually beating the SPY both to the upside and the downside. It really goes to show the broadening out nature of this market. So specifically today, why did the SPY finish positive? Why did the Nasdaq finish positive? We also had some very positive flows in small caps and mid caps too, and a lot of it had to do with housing and manufacturing data. It's starting to show economic strength. Manufacturing PMIs came in at 52.5. That's expansion. Existing home sales was 9.5% increase month over month. Very, very bullish. Part of the reason was just yesterday we were rallying because of, the soft landing hopes, rate cuts coming in, getting repriced for June, and pretty much the Fed confirmed that. They said, hey, regardless of what inflation's doing, rate cuts are probably coming before the November election. I think that's why the Fed's out here saying what they said. They want to get some of these cuts in before the election because, they don't want to take a stance in the political front. And then also with technology, Micron shares surged after earnings, and that provided a lift for semiconductors. And if semiconductors are rallying, that's going to lift the flows in the Nasdaq 100. If the Nasdaq 100 is moving, that's going to lift the S&P 500. And that's why stocks rallied today. It was a flow-on effect from yesterday. Good data, as well as some great news we got today, which led to a rally. Stocks putting up a green day. Now let's actually hop on the charts. Hopping on the charts, let's have a quick look at the indices. So look at the S&P 500 up 0.32%, Nasdaq up 0.44%, RSP up 0.68%, outperforming the market cap weighted indices. Then we had mid caps, small caps up 1.13%, 1.15%, and the IWM 0.89 and another 0.15 in after hours. So a bit of buying still happening there in the IWM. Very bullish for high beta and small size, and we're seeing a broadening out not just in sector and size. Gold was down on the day. The dollar slightly increased, and that's always going to happen after an FOMC like you did yesterday, and the crude fell ever so slightly here. But let's have a look at the S&P 500, guys. This is the daily chart. So you can see this is where we had that October correction, rally ever since. Let's zoom in, see what we have here on the day. So after two very, very bullish green candles, we finally put up a red bodied candle, however still green for the day, simply because we had a massive gap up. We had price discovery all the way to the upside. Sellers did come in at the top, closed in at the lows of the day. Now I would say that is a win to the bears intraday. However, in totality, in aggregate, bulls definitely did win, and there is a gap here that we can go and close, which will offer support for the bulls. Now again, when we're trading at all-time highs, there isn't much to say. We not just go, we put in an all-time wick high, we also then put in a closing high. Very, very bullish. What are we going to look to for the rest of the week? Now I've been saying all week that 50-90 is the area that bulls really want to hold, but with this new structure, I think ultimately what the bulls really want to hold right now is probably that section right there, 51.82. But the truth is, no matter what sellers try to do to this market in this week, bulls will find support there, bulls will find support there, bulls will find support there. So what you want to do is strategically buy at these key levels if we do pull back. But based on everything we've seen and market sentiment, the repricing of rates right now, guys, I wouldn't be surprised if we actually just keep rallying or just have like some form of a correction and then keep going higher. So we could go higher from here. We normally do see a little bit of weakness over the next 3 to 4 trading days in March. However, I think you should just see that as a buy the dip opportunity, and look to these levels that I've given you right here, 51.82, 51.37, 50.90 for any pullbacks, to buy those pullbacks. But all in all, we could just rally from here. You want to be long, you want to be exposed to this market because we are going higher, especially with what the Fed said yesterday. And even having a look at the weekly chart, look at this, super, super bullish. I mean, we had a little bit of volatility in the last 2 weeks, and now, we're closing at all-time highs, weekly new all-time highs, wick highs as well. We've never been higher in the S&P 500. Now, looking at market breadth, this is the new highs dashboard, and look at all of this green. We almost never see this. Short term, right, mid-term and long-term moving averages, green everywhere across the board in every sector. The S&P 1500, materials, comm services, cyclicals, defensives, energy, financials, healthcare, industrials, real estate, green everywhere across the board. And then we actually go ahead, look at new lows. There's like barely any new lows across here. New highs eclipsing new lows, and that's what you want to see in a bull market. Now I have the stats right here. So this is S&P 500 returns after 400 new highs or more on the New York Stock Exchange. Now do take this data quite a lot of grain of salt, guys. I'm going to tell you why. Now, firstly, 1 month later, average returns 1.9%. Look at the hit rate, 75%. 2 months later, 3.4%. 3 months later, 5.3%. 6 months later, 10%. 9 months later, 10.4%. And then it does get a bit choppy 9 months to 12 months later. And then we're looking at a 12-month average return of 5.6%. But a couple reasons why we need to take this with a grain of salt. There's not 30 stats right here. Any statistician will tell you need 30 outcomes for any data to be statistically significant. What we also have here is a concentration of data points. Look at 2021. These are all 2021 figures when the government dumped $1.5 trillion of stimulus into the market. Right, and that's skewing the data to one side. This data is skewed to 2021, but if we exclude 2021, and it's a very small data set, we normally see double-digit returns, very, very positive returns, and only 2018 was the one negative period 12 months later, but it was positive like 6 months later and pretty much flat 9 months on. And what we can draw from this data is that we are maybe approaching a medium-term top based on the 2021 data set. That being said, we're probably still anywhere 6, 9 to 12 months away from that medium-term top before anything significant does occur in the equity market. And that means you still want to be long because these are good gains. This is nearly a full year's worth of gains that you can eke out of the market before you really have to, pull back, draw cash, or maybe hedge your portfolio. Now looking at earnings, guys, so we got Micron yesterday. They were up 14% today. Great earnings. Today we're going to look at Nike as well as FedEx. These are two great parameters for the consumer, what consumers are buying and then how producers are getting their products to their consumers. So let's have a look at it. Now looking at Nike earnings, they came in with earnings per share of 0.98. They beat expectations with 0.74, and that was on sales of 12.43 billion and 12.28 billion. Now I didn't see a guide for Nike, but these initial earnings for the quarter, really good earnings, and the stock was up 4% after hours. The market seems to like it, and I think they're going to probably rally on that, especially as the market starts repricing future earnings. And maybe if we do get a guidance figure, maybe we have already, maybe I just didn't see it. Now looking at FedEx, They also beat EPS. Sales came in a little bit soft, but the share was up 14% on a $5 billion share buyback. You want to know what's crazy about this as well? FedEx saw low single-digit percentage declines in revenue year over year for 2024. Pretty much means that management are using financial engineering to pretty much keep EPS from declining. So they're going to buy back $5 billion worth of shares, which is about 7 to 8% of the company. Low single-digit percentage decline in revenue, and it shouldn't really affect earnings per share. And shareholders should still be pretty well compensated in the next year from FedEx. But the thing is that this can go from low single digits to high single digits very, very quickly. And you don't ever really want to see a decline in revenues, because it probably means that the company as a whole is either losing market share and they have to decrease their prices, or they don't have a competitive advantage, or they're losing their competitive advantage, and it's not really something you want to see. It's not really stocks you want to be in. That being said, FedEx was up 13-14% after hours just on their buyback, which is crazy to me. Now we got the latest II sentiment survey. Where will the stock market be in the next 6 months? And we have some major changes happening right here. This is the first time we've seen a massive uptick in the bulls from 21.9% to 27.2%. At the same time, bullish sentiment did tick down ever so slightly, but nothing to be concerned because we're still at very elevated levels compared to the historical average. And then the neutral rate actually decreased significantly. So what we actually saw was a lot of people went from the bullish and the neutral section towards the bearish section right here. And it just goes to show that sentiment is shifting a little bit. I wonder if that changes after yesterday's FOMC. But yeah, as it stands right now, the II sentiment survey has actually become a lot less bullish and a little bit more bearish in tone, especially with the bearish sentiment votes ticking up as they did. Now, this was very, very interesting. This is Goldman Sachs FOMC recap, and I'm going to read this for you, some of the key parts right here, because it's very interesting stuff. So the median FOMC participant continued to project 3 rate cuts into 2024, despite a 0.2 percentage point increase in the median core PCE inflation projection to 2.6%. We did speak about that yesterday. Our interpretation is that Chair Powell and a narrow majority of the committee feel strongly about not delaying cuts for too long and are targeting the June FOMC meeting for the first cut. The reason they're doing that is probably because of the election. They want to get these cuts out before the election season. In fact, the somewhat higher inflation forecast, which is now 0.2 percentage points above our own forecast of 2.4%, lowers the bar slightly for incoming inflation data to meet at the FOMC's expectations and keep a June cut on track. That is very, very key, because I do think they see the inflation data not coming in as they want, and that could delay cuts, and they want to avoid that situation, especially in an election here. They continue to expect cuts in June, September, and December for a total of 3 cuts in 2024. The 3 takeaways from Powell's press conference were: they're not concerned by the firmer January and February inflation data. That's because they've changed the goalpost. Secondly, Powell noted that while the FOMC raised its 2024 GDP growth forecast meaningfully, stronger growth has been made possible recently by faster growth of labor supply and is therefore not an argument against rate cuts. Thirdly, FOMC participants think it will be appropriate to slow the pace of balance sheet runoff fairly soon. And when you look at it in this light, you could say that Powell did come out a little bit dovish. I still think he came out more neutral. What they did was just change the goalpost, and relative to the goalpost, he sounded dovish, but relative to where the changes are, he came out pretty neutral. But all in all, the market seemed to like what he said, and I do think that we're probably going to go higher since the inflation target goalpost is changing, and it's probably likely we're going to get this cut in June. It's very, very likely we're going to get this cut in June. I don't think they want to mess around with the election season. They want to get 1 or 2 cuts before November 5th, and that's exactly what he did. Now let's actually have a look at some data. This is very interesting. So stocks on average rally 10% in the 6 months before an initial cut in soft landing scenarios. So we're about 3 months away from the cut, assuming June, right? So you have a look right here. This is 3 months. What normally happens? We normally just actually rally about another 5% to the first cut, which is right here. We can actually expect a little bit of volatility on the way, but all in all, we can actually expect higher price action in the S&P 500. Even at these highs, guys, even at these highs, the markets can get crazy. And then from there, after we do get the cut, we actually normally go sideways for about 2 months, as you can see, with quite a lot of volatility, both to the upside and the downside. And then we normally do actually rally quite significantly, between 4 to 6 months after. And we normally do finish about 6 or 7% higher after the rate cut. Once we get this rate cut, you want to buy pullbacks, but you actually just want to buy stocks leading up into the rate cut regardless. Now we know that leading into and after Fed fund rate cuts, equities rally, but what about other assets like yields and bonds? In non-recessionary periods, the US 2-year yield, this green line right here is what we're looking at, tends to be quite volatile, but not much happens. So we get the rate cut, and what does the 2-year yield do? It actually stays relatively flat for the first 18 months. Then we normally get the drop. We also do get a little bit of sell side in yields after the rate cut, but normally it stays pretty flat and sometimes even goes higher in non-recessionary periods. In recessionary periods and recessionary periods ex-COVID, what normally happens is we actually just get a significant drop in yields, and then the full sample of the median is we do get a moderate drop in yields. All in all, we can expect yields to be lower after rate cuts, but in periods where it's non-recessionary, not as much as we would expect. Now, looking at the dollar stays relatively flat for the first year and a half, a little bit increase, and then it rallies into the 2-year period. Do take into consideration this is 2 years. Now, this is a non-recessionary period. In recessionary periods, ex-COVID and the full sample of the median, it's roughly the same. We actually stay relatively flat, and then we do rally, but when there's no recession, the dollar rallies quite significantly. And you would think it's the opposite, where in a recession people would want to hold US dollars, but no, that's not the case according to this data. Now, what sectors perform best around rate cuts? Now, this is the median sector return relative to the S&P 500 during 12 months following the start of the Fed cutting cycle. And according to this data right here, staples, healthcare, and energy outperform the SPY quite significantly. This is the hit rate. So you're looking at 65% and above for these three sectors of energy, staples, healthcare, and they outperform the SPY by like 8 percentage points here for healthcare, 7 percentage points for staples, and then 2 percentage points for energy. The worst sectors to be in around Fed cutting cycles is normally infotech, financials, and utilities, which is crazy when you think about that. I would love to see this data separated for sector performance when rate cuts are done to normalize policy versus recession. I think we would see a much different tone. That being said, the data of 8 episodes since 1984 is here for you guys to see, and normally healthcare, staples, and energy are the best performing sectors following the start of a Fed cutting cycle. Now let's switch gears and actually talk about fund managers. We've been looking a lot at fund managers and what they think. So right now, this is the NAM exposure number, and as of the 13th of March, they're sitting at 104.75. In other words, this means that fund managers are 104% leveraged to US equities. So, they're using a bit of leverage in their portfolios. The reason why I show you on the March 13th, even though it is closer to the 20th right now, is simply because we got the weekly flows by client sector and size from BOFA, and this is for last week, the 11th to 15th. So you could say this is what those fund managers are buying, and you could see here that they are actually buying equities. That data does relate to us. So they're buying ETFs, so we can assume Nasdaq 100, S&P 500, right? And then if we go into sector specifics, financials was a big one, comm services was another big one, as well as technology and discretionary. So it does look like they were buying cyclicals as well as growth in the lead up to the FOMC that we had yesterday, and these funds would be up a lot on their positions. What they didn't buy was stuff like industrials, materials, healthcare, real estate. So rate sensitive names and defensive names, they didn't really want any of. They wanted cyclicals and they wanted growth in their portfolios, and they were kind of neutral on stuff like energy, utilities, and staples. All in all, this is what fund managers bought last week, and they are fairly heavily exposed to equities at above 100%. So they're leveraged their portfolios right now, and that's what you get in bull markets. In bull markets, you tend to see a lot of use of leverage, margin debt, that sort of thing. Big changes in the gamma tape, guys. Firstly, the biggest thing you can see right here, we moved up to the 52.50 strike. Now, normally we don't stay at the 50 strikes for very long. We actually normally just go to the next round number pretty quickly. Actually, I don't know why, but I think people just like the round numbers. They like to put their strikes at like 5,200, 5,300, 5,400, and dealers like to hedge there as well. So that's why these gamma nodes normally move pretty quickly up. So if you go to like 51.50, it'll go to 5,200 pretty quickly. And then if it's at 52.50, it'll go to 5,300 quickly. So very, very bullish. Generally speaking, that's what happens. When spot price gets above the call gamma strike, normally we move up very, very quickly to the next higher level. And if we're below the gamma flip zone, in the same instance, if we get below a strike, the gamma flip zone normally moves down. So this is very bullish action, and I do expect the 5,300 strike to start getting built out quite significantly. Something else to note is that we're starting to really build a lot of gamma a lot earlier than I thought. I didn't think we'd have this much positive positive gamma on the tape, but after what the Fed came out and said yesterday, dovish sentiment all over. Now, one thing to note is that even though this looks on a day-to-day basis, it looks exactly the same, what you actually want to look at is these numbers right here. So last week they were at like 0.25, 0.5, and 1 was here. Now it's 0.51. 1.5, and you'll start to see this soon will become 1, this will be 1.5, and this will be 2, and so on. So that's what I mean when I say positive gamma, negative gamma getting built in the tape. Even though it looks the same, you got to look at these numbers on either side. All right, so yeah, bullish sentiment, we've moved up to 5250, expect 5300 soon, and expect price to keep moving up, because in positive gamma, what do? We buy dips, sell rips all the way to the call gamma strike, because it acts like a magnet. Moving on to seasonality. Now, one thing I want to note here, typically in March, we do come down and then rally somewhere in this period right here. Is it going to happen? It definitely can. Is it most likely going to happen? Probably not. Based on the sentiment, if anything, we might have a minor pullback on one day, maybe for half a day, and then we're just going to keep going higher. I do think we're going to go higher for March. I don't think we're actually going to get back to these lows, not in March. Maybe April. There's a bit of momentum seasonality that does show a very, very negative periods. In periods where we've had very, very strong momentum years leading up into March, there is historical precedent for a pretty big pullback in April and then a continued rally for the rest of the year. However, we'll get to that when April unfolds. I have the data a little bit later, but for now, I do think if we do get a dip, you want to buy that dip in March, looking for higher price action. That being said, we could also just rally from here based on the tone, the Fed, how pulled up everybody is, based on everything I showed you with gamma. Right now, it's buy the dip, buy the highs, buy high, sell higher, buy. Guys, in today's video, we're just going to have a look at the 11 S&P 500 sectors, where they are, where they're going. What do the charts look like? We don't do enough of this on this channel. We normally look at sectors versus the S&P 500, but often that doesn't give us the full picture, because the S&P 500 can outperform a sector, and that sector can still do really, really well. And one of them is actually financials. It's performed about in line in terms of year-to-date performance as the S&P 500, but this is actually a very healthy looking chart right here. We're actually approaching all-time highs. We actually made a closing high, not a wick high, and I do think we're going to go get these all-time highs here at 41. Now, for those of you that don't know, I had my top sector picks for the year in 2024. I gave it on Twitter. Financials was one of them, and look at where we are right now. Absolutely insane what financials have done after breaking out of this breakout here. And this actually looks very much like the IWM chart. This probably looks like what the IWM wants to be like in like 6 to 12 months. But yeah, we've had like this correction in time, this balance zone here broke out. Kind of, I guess you could say, use as resistance. I mean, you consider that a resistance, and then we've broken out ever since. And how many green candles have we put in since the top? And that's very strong, and we're probably going to go higher. We break this 41 area right here, and then we could look to, well, I guess the next logical zone would be like 43, 44, 45. There's nothing above this. This is the highest ever been. So very bullish on financials for the most part, and I think it's going to continue. 2025 financial earnings look really, really good, particularly for banks. Now, looking at real estate, and it's not looking like a good chart. I mean, this is actually a pretty healthy trend. As you can see, we put a low right here. We've actually made a high, but the thing is, we didn't go ahead and break this key level right here. We actually didn't get a closing high. We did go up. We did put in a high right here. We did put in a higher low, and now we're trying to, break out above this line, but it doesn't look too good. That weekly candle looks pretty heavy. So what real estate needs to do is stay above this line right here and go ahead and try and reach for that 40 area. They definitely can do it for sure. It's a lot's going to be dependent on rate cuts, and I do think that real estate are going to outperform in the next few months if we do get the rate cuts that we're expecting. And I do think that this right here, I do think that this is actually a bottom for a lot of real estate. I was looking at stuff like office and multifamily, and I do think we're very, very close to a bottom, if not the bottom has already been put in. And I do think there's material upside for real estate looking ahead in 2025, 6 and 7, but you need a long enough time horizon for real estate. Now, looking at healthcare, guys, this right here, these are all-time highs pretty much. This is all-time highs. So as long as healthcare holds above the 144 area right here, it's just up and away, and do expect higher price action. And even if we do go lower, there's like material levels that will offer like a lot of support here for healthcare on the way down. So if we do get pullbacks in healthcare, look to just buy the dips, because earnings are looking good in 2025-26. Looking at energy, not much to say. This right here, this blue line, 93, is actually an all-time high. So we're still yet to even get a closing high, but it does look like we are going to go out and get it, especially with energy earnings really being revised to the upside. All energy needs to do is go ahead, break above 93 right here, and then we should move higher. I mean, energy earnings right now is actually the worst in the S&P 500. It's sitting at like something like negative 25 year over year. But that just goes to show that so much of this is already priced in, with energy trading at about a 10 or 11 PE. Actually, no, it's closer to a 12 forward PE. But yeah, a lot of this, lack of earnings or earnings decline is already priced in. And I think we just go up from here, especially as earnings improve for energy next year. Looking at technology, now we formed a massive cup right here with this handle. We've broken above the 177, very, very strong. We've had very, very little in the way of pullbacks in terms of technology. We did right here, and we are starting to see a pullback, not in price, but in time, a correction in time up the top right here. And you can see we've got some red candles, we've got some green candles. And I do expect technology to probably continue sideways as long as the Apple stuff continues with China, weak sales. And I do believe the DOJ recently filed for an antitrust, or they'll be filing today or tomorrow for an antitrust. So we should see some more sideways action here in technology. But all in all, I definitely am bullish. This is all-time highs, and you don't want to fight this trend. If we do get a pullback in price, look at it as a buy the dip opportunities, especially if we get to around this 195, 185 area in technology. I mean, considering where earnings are going for not just the next 2 years, but the next 5 years, I've seen like some really crazy projections. We're looking at something like a 17% earnings growth in technology for the next 5 years compounded annually. So yeah, I would look to buy any pullbacks for the future, but this is not actually a bad thing. Very healthy to have this correction at the top at all-time highs. Looking at semiconductors, one of the biggest drivers of technology. Now, this is a very ugly candle, and we are seeing material weakness, not so much in Nvidia, but the rest of the semiconductor sector. Very similar to technology, we have this cup and handle. They have broken out. A bit of weakness up the top right here. Again, this candle does look very, very ugly. However, I wouldn't fight the trend. I'd say more sideways consolidation as we digest this price action that we've had in semiconductors, and then a continued move higher, especially with Nvidia's new chips coming out. I think a new upgrade cycle after the H100 upgrade cycle is intact, and I think the upgrade cycle, which I was predicting to go until 2026, is going to go until 2027. Looking at consumer discretionary, we are kind of in this like rising wedge right here, and we probably go up down trend and then break to the upside, especially if we do get like some bullish momentum in Tesla. I was actually looking at Tesla, and I didn't think the stock is as cheap as I thought it was. I might just do that. I might look at Tesla on my weekend video, but I was looking at some valuation metrics. One of my valuation metrics had Tesla at 193 fair value. The stock right now is trading at like 170, maybe in the 160 range. And I was looking at that as very, very attractive to get into, considering the momentum in FSD, as well as Optimus humanoid robots. I think that will have serious growth to it. And I think that's in terms of the AI trend, humanoid robots are going to be a very big trend looking in the future. So I think Tesla might be a good buy. I'm going to discuss it actually confirmed. It'll be in my weekend video, but yeah, that'll help this consumer discretionary, assuming that happens. But all in all, I do think we continue to trade this very tight range and weird technical analysis rising wedge that I've drawn. Looking at XLC Com Services, we're sort of like forming like a balance area there. We've broken above. Do expect higher price action. Not much more to say. Even with Google not performing in the sector, we've continued to move higher. So kind of crazy when you think about that. Looking at industrials, this is a crazy chart. Very similar to XLC. We got this like resistance line, we've broken above, and it probably means we do go higher in industrials, and industrials is looking very good. This is a very, very healthy chart. Actually, you could say it looks like technology with sort of like a cup here, a handle, and a breakout, and another breakout happening right there. Not much to say. The breakout's in motion, and buy pullbacks, buy dips, sell rips, look to higher price action. Now looking at materials, very similar to what we saw with industrials, we have like this resistance line right here. It's broken out, but it's significantly stronger and it's approaching all-time highs. Do expect these all-time highs to be hit in materials and move above, and then if we do like draw a line right here, all-time highs, push above, and then look to higher price action, especially if we push above, use as resistance, we can expect probably the 100 handle here in materials in 2024. That is definitely not off the table. I do think that materials has a lot of upside, especially because a lot of these stocks are trading at like an 11 times 12 times PE, very cheap, high free cash flow yield. Earnings are set to decline, but that is expected to change in the next coming years. I think materials are expecting negative earnings growth in 2025 and then 6% in 2026. So we'll see how that goes, but I think a lot of it's priced in, and this is exactly what we're seeing right now with this rally. We're forming higher lows, making higher highs, breaking all-time highs, bullish. Now looking at value, this is S&P 500 value, and breakouts after breakouts, and we're at all-time highs right here. And when we're at all-time highs, do expect higher price action. If we do get pullbacks, you can look at stuff like 46, 44, 43 for great pullback locations to buy the value ETF, but looking very, very strong. This is a very strong trend. We got a low, higher low, higher low, all-time high at the same time. Putting in highs, we made a high right here, equal high, higher high, higher high, all-time high. That's a very, very strong trend, and you want to buy pullbacks, Now looking at growth is actually about to hit all-time highs on a wick basis. It actually did hit all-time highs on a closing basis. This is very bullish, very similar to value. We're just going to continue the trend upward, and you want to buy pullbacks at strategic levels. Look at stuff like 70, 68, 66, these psychological levels. Those are good levels to buy, but very similar to technology and semis. You sort of form this cup right here, a handle we've broken above, and you want to buy on weakness, buy pullbacks, and look to higher price action because the growth ETF is going higher, especially after making all-time highs. And you see this right here, a lot of this sell-off we saw in 2022 had to do with like hyper growth names. A lot of them are in this ETF, stuff like Zoom, stuff like Fubo. And yeah, to see that we actually, hit all-time highs on a closing basis and breaking out, we just got to get above this line, use the support, look to higher price action, and Bob's your uncle. So very bullish charts across all the sectors, the value names, growth names, and we are in a bull market. The charts are looking bullish, sectors are looking bullish, small mid caps looking bullish, not so much smalls, but mid caps looking bullish, large caps looking bullish. And I wouldn't fight the trend, guys. I wouldn't fight the trend. Buy pullbacks. We are in a bull market. It could go on for years. Don't fight the trend. The trend is your friend. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, like this video, and leave a comment for the algorithm. Cheers.